From our 22 News Broadcast Center, this is 22 News in Focus.
Good Sunday afternoon and welcome to 22 News in Focus. I'm Kate Walsh. Millions of Americans are living paycheck to paycheck. According to a recent bank rate report, nearly 6 in 10 Americans don't have enough savings to cover a $500 or $1,000 emergency expense. April is Financial Literacy Month, so today on 22 News in Focus, we'll be discussing the importance of personal finance education. We'll also learn about programs available to help you get on track to financial stability. And joining me today are the experts in this field: Jennifer Conley, President of Junior Achievement of Western Massachusetts; John Resk, Vice President of Marketing for the UMass 5 College Federal Credit Union; and Jennifer Kinsman, Director of Community Impact for the United Way of Pioneer Valley. Thank you all for being here today. You each offer a different perspective on this topic. So first, I want to go down the line and hear from you what your background is in financial literacy and what your organization offers to people. I'll start with you.
Okay, I'm with Junior Achievement, and Junior Achievement actually started here in Springfield, Mass. in 1919, so we have close to almost 100 years of teaching financial literacy in business. I've been with the organization for almost 20 years, so we work with students from kindergarten through grade 12. And financial literacy is a key part of all the programs that we do.
Excellent.
Yes, I'm John Resk, and I'm with the UMass 5 College Credit Union. As a credit union, financial literacy is actually one of our key principles in educating our members to be good consumers of financial services. I've been with the credit union for over 20 years and have handled their financial literacy courses and outreach during that time period. And we touch high school kids, college kids, and adults in the financial literacy area.
Awesome.
United Way of Pioneer Valley has been really interested in financial literacy for a long time. And about 5 years ago, they started studying the viability of financial success centers and how that would operate in our communities. And since then, we partnered with several different agencies, a number of funders in the region, and we've opened up 4 different financial success centers that we call Thrive to serve both community college students and community residents. And while we offer a number of services, the primary focus is on one-to-one financial coaching.
That's important. Do you find that in general people are at first maybe embarrassed to be willing to participate in these types of programs? Money is something we don't usually like to talk about with people, especially strangers, especially if you're doing something wrong or if you're in debt. So is it difficult to find people to participate in these programs and open up about it?
From our perspective, all of our programs are presented by volunteers, so often the challenge might be to get a volunteer that's going to teach personal finance in 11th or 12th grade. And well, I don't know this about personal finance, or that's not my profession. And whereas in kindergarten you're talking about wants and needs, and they feel a little more comfortable doing that. So that's our only challenge, is that people might feel that they're not qualified to do it, but our materials are very user-friendly, and we just want to make sure that we do a lot with college students teaching, elementary students and high school students, so it really helps them at the same time that they're learning. It's like osmosis.
Remembering things that maybe they forgot too, right?
Or they're an economics class student from Elms College. We get all the students every fall that take economics, and when they go back they find out that they taught about opportunity costs, and it's a question on their tests. So it does help them in their courses.
It's a win-win.
too. Yeah.
We find that a lot of the adults are coming in to ask us about stuff, so they're not really embarrassed. They're in a situation where they need some help, or we recommend that they go one of our workshops or something of that nature. When you have a dozen adults in the room to teach them about financial literacy, they all sort of know they're in the same boat. So that alone, I think, is helpful for people, but they're very eager to understand. And one of the things we usually say to them is, if your parents had taught you about financial literacy, you probably wouldn't be in this room today, and they all get that, and they're very much interested in learning to move forward.
Interesting.
I think we found that a number of our clients come from referrals. Nobody likes to talk about money. A lot of people just want to stick their heads in the sand. And once somebody does step their feet right through the door and we can help them, they can spread the word with their friends and family that seems to work. But I myself don't even talk enough to my own kids about this topic, so I understand.
Yeah, and you know, I hear a lot from people, oh, I took chemistry, I took biology 3, all of the stuff that if they're going into, let's say, an English major, they really probably don't need, but we tend to miss out on learning how to balance a checkbook and learning about the stock market and stuff like that. So why is that, do you think, in your perspective, we don't learn about these things growing up when they're so key to our lives?
I find that Massachusetts is one of many states that don't mandate or don't legislate that we have financial literacy as a program for our students, and often it's if it's available, it's an elective. So if the students are taking AP classes and things like that, they don't have time to work in an elective on personal finance. So I think that's the biggest challenge. There was a report out recently that rated all the states in the United States on their financial literacy knowledge and how they handled their money, and overall Massachusetts rates a B, which is good because the United States was only a C- as a whole. However, on having financial literacy classes available in high schools, Massachusetts was an F. So it's a challenge, I think.
Do you find that there's a certain age group that comes in looking for help, or is it really everyone?
For us, it's everyone, I think. And you'd be surprised how many people are in their 50s or 60s that are coming in. And I think the retirement thing kicks in. Like, I really now I really have to pay attention to my money now, you know, because I have just so much of it. So I think some of that is happening there too. You know, and you were talking about to your children, and I think that's one of the big issues is that, you know, you need to speak with your children about what's going on. You know, if there's a financial issue in the house, chances are they know it. And, you know, we always talk about how you tell a child to turn off the lights. But have you ever actually showed them the electric bill? And say, actually, this number we're trying to get down, so let's work on it. You know, we never make those connections for them, and that's really, really hard. And there's just a lot of things you can do in your everyday with children to go ahead and reinforce that. Unfortunately, many of the parents don't even have the skills they need, so it's even harder. So it is a real dilemma. And Jennifer, the whole fact that Massachusetts is one of the only states in the union that doesn't think that financial literacy is important is mind-boggling to me.
Yeah, and we are going to talk about some programs that the state is coming up with now to try to change all of that, but it does seem, you know, at least in Massachusetts here, we don't really get much of it in school. And do you find that as well through United Way?
Absolutely. We find that most of our clients have never had anybody sit down with them and explain, okay, here's how you're going to get through the month. So that's what we do, but we try to do it in a very non-challenging way with goal setting and finding out a lot about the person first, where they want to get to, what's troubling them financially, and taking small steps, baby steps, short-term goals and long-term goals. But our whole model is based on the financial coaching model, so nobody's dictating to somebody how they must handle their finances. They're being given tools and a long-term plan. And the program is meant for them to come back on a regular basis so that they're meeting with that same coach over and over and developing trust back and forth and starting to meet those short-term goals and then the long-term goals. So that part is very exciting. Getting them in the door is our biggest challenge.
And it must be difficult too with teaching because not everyone is in the same boat with their how much they have saved, what their lifestyle is. So the one-on-one, I'm sure, works really well, but in a group setting, you probably have to speak in more general terms, right? About these are what the things you should be looking at, and this is the recommendations we have. Where one-on-one, you can talk about, okay, $50 saved this week and that kind of thing.
Yeah, and I think the other thing too is when people think financial literacy, they think budgeting, and actually understanding credit is more important. Because if you make a bad credit decision and you make a bad borrowing decision, you're probably living with that for several years. And if you've made one, you're going to probably make another one. And we find a lot of people, it's not that they don't have enough money, they've just made some terrible borrowing decisions, and they're paying ridiculous interest rates and very bad terms, and they in fact just can't keep up with that. So we really believe that, you know, understanding credit has to be a vital portion of that overall financial literacy, because that is critical, and that is where you can really mess things up for yourself, and it takes so hard to get out of it, you know.
I think those classes are really important. We offer those too. We've been really fortunate to be able to partner with a number of the banks in the region. And they come in and teach our money skills classes, and that can be for a group anywhere from 2 up till 12, 15, 20 people. But the important thing about that model is that it's non-threatening, because there are many people in the room, and you can use these instances of these pretend people who got themselves into trouble because they rented furniture and they have this bill every month, and they bought some things they shouldn't have purchased, and on and on. And they might see themselves in that and later on say, oh, I bet I could benefit from some financial coaching. That's as a result of being in a group setting. I think that's the benefit of the classes.
All right, well, we're going to talk about financial literacy more, and we'll get to you about junior achievement especially, and how young people are learning all of these skills that we really all should know early on in life. So you're watching 22 News in Focus. We'll be right back. Welcome back to 22 News in Focus. Today we're talking about financial literacy and programs that can help people learn to manage their money. So we were just talking about the different types of programs, the beginning of talking about the different types of programs that are offered in Western Massachusetts, whether it's a group setting or one-on-one. And during the break, I had said, you know, I wish I took a college course on some kind of financial literacy, because everyone needs some help with this type of thing. But you were saying, shockingly, those classes are canceled oftentimes.
They don't seem to fill up. The colleges try to offer them, but from what we've seen, students aren't necessarily signing up. That doesn't seem to be particularly interesting to them.
And I think they're really busy. I mean, you know, that's one of those things where does that fall in the priority of being in school? And if they don't really realize how important it is, then it's not going to get the higher ranking, so to speak. So that's another, I think, roadblock potentially for why they're not being fulfilled like you would think they would be.
And that's where junior achievement comes in handy for people, because they can learn it in high school, and then they don't have to worry about it when they get into their first year of college and realize they're on their own and have real bills to pay. So how does junior achievement help these high school students? Talk about the program itself and how the peer-to-peer works.
We actually start with programs as early as kindergarten, talking about wants and needs. We give them a bank, and we talk about saving money and how they have to earn their money. It goes all the way up to running a business. In the 3rd grade, they learn about writing checks and what's a bank and a debit card. Middle grades, they actually have an activity where they try to understand the difference, learn the difference between a debit card and a credit card. Which one charges interest, which one, you know, comes directly out of your checking account, and you need money there to do that. And we have programs where we call it our JA High School Heroes, and we have high school students who have had a JA program who then go into grades K1, 2, and they're actually teaching. They're the volunteers that go in, and so they're teaching financial literacy. And we have college students that go into the public schools, and they're teaching. So sometimes they learn by just doing, and they get that information, and it might not be something they got in 5th grade or they got, you know, but that we start taxes in 2nd grade.
Wow.
And, you know, they learn that they're paid a certain amount of money to be a donut worker because they made donuts on one session. The next session they come in and they get paid $5 for being a donut worker, but then they have the police and the firemen, and how do we pay those people, and the teachers, and they have the tax collector button, and the tax collector comes around and takes, you know, $2 of your $5, and sometimes that doesn't go over too well.
Yeah, that's a real reality check.
Yeah, that's a reality check. And then they pay the people, you know, the firemen and the policemen and the army and the teachers and things like that. So I think best situation would be a continuum where they're exposed to it multiple times at different ages, and it starts a conversation. With our middle graders, we did the one with the debit and credit cards, and a lot of the students came up to us after and said, can I take this home? I want to show my mother, I want to show my grandmother, you know, I want to save this for when I'm in college so I can look back and make good decisions. So it's really key, I think, to offer it at different ages and stages, because people will get more things out of it.
And does it work so that maybe one school district has junior achievement K through 12, or is it kind of sporadic? You know, some districts have it in 2nd grade, and some years they might have it in 8th grade. And
it's unfortunately a little sporadic. Our largest concentration is here in Hampden County, and Springfield is our largest school district that we work with, and some of them do get it. Our majority, we're kind of reaching out to the high schools. We used to be 85% of our programs were in elementary schools because it's warm and fuzzy, and you know, everybody likes to work with a kindergartner and things. And then we grew into the high schools, and now we're reaching down in the middle grades. And I think the middle grades was last because everybody remembers what middle grades was like. And getting a volunteer to go in there is a little challenging.
Yeah.
But you know, you do learn from the students and things like that. So that's what we're hoping, is that, you know, they will get them, and it is provided to the schools at no cost. So it's something that, you know, we work with the teachers and the parents and try to get parents in there, and business people and college students, high school students.
And again, it's during the school day, right?
Absolutely.
So it's that whole thing with, is this important enough to make time for it, no matter what grade you're in or what part of life? And
that's our challenge. We're very fortunate that all of our programs are correlated to the Common Core in English, language arts, and math. And so that we feel that it fits in a social studies class, it fits in a math class. It's just kind of working around the testing schedule. There's a lot of testing, and that's probably our biggest challenge, is finding what they call blackboard space in the classrooms. Yep.
The other thing I was thinking about too, and you had mentioned, you know, younger students learning how to balance a checkbook, and then later learning about credit and debit. How often nowadays do people really use their checkbook versus credit and debit? And so do you have to change the way you teach people about finances based on technology changes? There are so many apps nowadays where you can just let the app basically track your finances for you, but I'm sure there's a downside to that.
That's an interesting comment, because in college, we have a branch on the UMass campus, and they walk in and they ask for a debit card. And they have no idea that a checking account is connected with it. All they know is that the debit card is what works, and that's all that matters. We tell the story of the kid who was going to get an apartment, and they needed a canceled check, you know, to run it through. And he called his father and said, "Do I have any of those? I've never seen that before," you know. But it's true. I mean, you use a card for everything, and that is how they're thinking, is that, you know, the debit card is what it is. And by the way, that happens to be a checking account. And, you know, with online banking and everything else, I don't think the technical stuff is really the issue. There are so many apps, and any online banking system is going to have some kind of a budget tracker built into it and so forth. This is about psychology, and it's getting people in the right frame of mind as to what this is all about. The tools are out there, you know, whether you use a shoebox and a pencil and a paper, it really doesn't matter. It's, you know, you talk about needs and wants. It's, you know, it's funny you teach that in kindergarten, because there are adults who still don't understand the difference between a need and a want, and that's right there is the problem. And so I think it's a lot more the psychology of it, and trying to do it in a way that's either fun or has a little bit of humor, or at least is very approachable, is key. And, you know, the younger kids, they don't really know any better, which is great, because you can tell them, you know, this is how it goes. When you get older, it's much harder, and people have, you know, predisposed positions about certain things, and so there's a little bit of work there. But humor does work sometimes, because we do use that a lot in our classrooms, and, you know, the absurdity of things really hits home when you go like, really? Oh, geez, and like, I do that, you know, kind of a thing too. So
that's interesting. And so would you say that you recommend people not use these online apps and all these tracker things, or are they a good thing?
I think whatever works for the individual, they should try. And if it's something that kind of opens the door for them to take some positive action or to become responsible bankers, then that's a wonderful thing. And we don't espouse any particular app or anything like that, but we might throw out a few suggestions if someone's floundering a little bit. It's really just generating a little bit of interest in the topic, and it really is going back to that basic needs versus wants. And we teach that in our money skills classes because it's so important. And do you want to pay the rent and be able to stay in that apartment, or did you really need those shoes? It seriously comes down to that. And can you write a check, for those who still do write checks, and, you know, run to the bank and somehow get some more money to put in there to cover those shoes that you're going to buy on the way after paying your rent. It comes down to common sense, responsibility, and attention to a few details.
There's also something about understanding the mathematics of it. You know, we talk about you get a cup of coffee every day for $1.75 a day on your way to work. But you do that 5 times a week times 50 weeks a year. You actually spent about $450 on coffee.
I always hate hearing that statistic.
You know, but that's how you have to think about it, especially on smaller types of purchases. You know, we call them the money gobblers, right? It just gobbles up that little tiny thing. But I think anytime someone takes it out to the annual expense, that's what really does hit home. And then you can make your decision of, do I really want to spend $500 on coffee a year, or do I want to make it at home and bring it with me? So that's sort of the mentality we have to get people into, so they understand for themselves what, and then they can decide what's your priority.
Right.
You know, and we also, the other thing I think is important is that every expense category has a range. So, you know, transportation is at 5 to 10% of your budget or whatever, because maybe somebody wants to have a really nice car and they don't care about the place they live in. But the point is, there is a range that you should be working in with each of your major categories of spending.
All right, well, we're going to elaborate on that and talk about budgeting in general after the break. You're watching 22 News in Focus. You're watching 22 News in Focus. Today we're talking about financial literacy and best practices for managing your money. Now, what exactly are we talking about when we say financial security? Everyone probably has a different definition of what that might mean, right? Is there any standard that everyone should live by when it comes to security?
It's a function of where you are in your life. I mean, most people I would think that when you talk about financial security, you're talking about, you know, can I handle retirement without, on my own, if you will? Can I afford that? For other people, it could be very short term. It could be an emergency fund that you need, and I think we probably would agree that, you know, 3 to 6 months of your expenses is probably what you ought to have in the bank and not touched unless you need it. I mean, that gives you a lot of financial security. So I think it all depends on where you are within your life, and I think that's another problem you have, because you get college kids that want to work on investments, but they have no emergency funds saved up at all. So you have to explain to them that, no, you really need to have money set aside. So I think, you know, it starts with the very basics of, you know, how are you making it month to month? And I think financial security to a certain degree is making sure you have something aside in case you need it.
When we do budgeting with the students, we actually, the first category is savings. And we ask them, why do you think savings is first? And they're like, well, it's important to do this. I said, yeah, it is. It's important because you want things short term. You need things long term. I said, but also you work hard every day. And you want to have something you're saying to yourself, I'm important, what my hopes and dreams are important, and that's why it's first. So if you put it into savings first, then, you know, then you don't get that coffee.
Yeah, right.
That's $1. So you go, okay, that $4.50 is going into the savings.
We do a zero-based budgeting idea that if you make $2,000 a month, your budget should equal $2,000, which includes savings. It's considered a cost item, right? So, you know, the famous saying of, you know, pay yourself first,
right,
you know, that my grandfather used to tell me, well, that's actually still works. And the idea here is that if you have money left over, either you could save more or you could pay down your debt quicker. And that's really the key, and you know, you've got that extra. So I think if people take that approach, it works out pretty good.
So take a standard amount each month that works for you, put it into your savings account first, then pay off your rent or mortgage for the month and car payments, right, and that kind of thing. And then whatever's left over, you deal with the debt you might have or under other expenses. Is that how?
I think all of us would agree that you should pay yourself first, and I wish everybody could.
Yes.
But we do work with a lot of very low income people who are just struggling, and they truly don't have anything to put aside. So that's where we work with the short-term goals. And so any few dollars they may have extra might go to paying down a debt or an old electric bill or something, because that feels good when that's done. And that actually is a sense of security, that they've paid down a debt and don't have that hanging over their heads anymore. And then as they work towards getting a better job or a second part-time job or something like that, then they can start moving towards savings. And we would always advocate for that, but sometimes it's simply not possible.
So what would you say are some of the biggest mistakes people make when it comes to their finances in general?
I think they don't start saving soon enough. I mean, if you started when you were 16, you got your first job, and you put aside $2,000 a year for 4 years, that's it. And you said, okay, that's my money. You put it in a Roth IRA, and you never touch it. And then you go on with all the expenses you get after, after that time when you're in college and things like that. And you live your life and you just let it sit there. You would have, because of compound interest, probably over $1 million to retire on just from the money that you saved. Maybe that when you were young you really didn't need it as much. And then you can go along with the income that you have. So we kind of try to introduce the students to starting young and being able to work it that way. And so that, even if it's the loose change that you have, throw that in the bank, because all of that adds up after a while.
And while we're on that topic, is there an importance still to CDs? I remember when I was growing up, which wasn't that long ago, CDs were actually legitimate, but now the interest rate is so low. Is it better to just have a savings account?
Well, I mean, I think keep in mind what you're talking about is an insured product. So, you put your $5,000 in a CD, you're going to get your $5,000 out. This is not an investment. And so you're trading off risk versus profit, right? So, you may be okay with only getting 0.5% because you cannot lose that money. And so I think that's how you have to look at any kind of a savings insured product. But going back to your idea of mistakes, I think one of the biggest mistakes is people do not understand how to borrow. They don't read the fine print. They don't understand the interest rate that they're paying. They don't, none of that. Think about when you go get a car. They'll usually ask you, well, how much do you want to spend? They're not interested, and they will figure out how to make that work, even if you're taking out a 72-month auto loan, which is actually pretty long, if you will, because they got you into that car for that payment. So really understanding what you're borrowing and how you're paying that back is critical. And understanding your credit score, because your credit score is going to probably determine, first of all, whether you get a loan, and second of all, probably what you're going to pay for that loan. And it could be the difference between paying 5 or 6% or paying 15%. And that's a big number. And I think if we could teach everybody just understanding what a credit score is and how it works, and that you actually have control over your credit score, and you can make that thing go down or you can make it go up, depending on what you're doing. And to me, I think that's critical, because if you can save money on interest payments that you're making, that's how you can go ahead and have that extra money to do the savings that you're talking about. But if you've just paying some ridiculous rate on an auto loan, you're never going to have the money to do it, and chances are the car's probably not going to outlast the auto loan to begin with. And we see that all the time when people want to refinance a car and they're upside down. They actually owe more than the car is worth. And it happens all the time, and you can't help that person, or it's very difficult to. We try our best, but if you owe $3,000 or $4,000 on your car, and now you want to, you're trying to refinance it, and it's like the car's not worth what you have left on the auto loan, and they don't understand that, and then you tell them, well, you took out an 84-month auto loan. That's why you never got ahead on this. And that's very, very hard. You make a bad borrowing decision, it stays with you for a long time.
And I want to talk to you too about bad decisions that people make, but first, since we're talking about credit scores, there was something that just came out actually in the past few days, where the companies looking into how they make a credit score are maybe changing the way that the factors that they look at. And so where it might have been okay for you to pay, the minimum amount on your credit card balance each month, now they're saying you really should pay it all in full if you can, because it could affect your credit score. Is that something that you recommend to people in general anyway? Well,
first of all, they're always adjusting the credit score model, so that happens continuously. There are some people that are trying to work on a score that doesn't necessarily deal with your credit in the sense of maybe you're young enough that you don't have a lot of credit, so it's very hard. So they may be looking at things like, do you pay your cell phone bill, and some things like that to try to establish a credit line, a credit score for you. The key, a third of your credit score is simply paying your bills on time. It's that simple. Just pay it on time. A third of your score. Another third is the balance of your outstanding debts. So obviously, lowering those as best you can helps. Now that's 2/3. The rest of the score will take care of itself. Everybody wants to do all these things, and we say to them, no, just keep your balances low, pay on time, and you're all set. One of the things that we recommend everybody do is put your minimum payment on an automatic payment plan for your credit card. That way, you know a third of your score is going to be okay on that because you've paid on time. Then when the bill comes in, then pay down the balance a little bit. Write another check and pay another $50 or $75 or whatever you can do, so you're working both sides of that. But that's really critical for them to understand that, because your score, everything revolves around your score in so many aspects of your life now.
We actually have to take a break, but Jennifer, I do want to start with you in our next segment to talk about what you think are some of the biggest mistakes people make. So you're watching 22 News in Focus. We'll be right back. Welcome back to 22 News in Focus. We're talking today about financial literacy, something everyone can relate to. And we were just talking about some of the biggest mistakes you find people make when it comes to their finances. So Jennifer, what would you say from your perspective are some of those mistakes?
I think some of them are ignoring some of the early signs that they might be in trouble and not paying attention, overspending. And then when they do realize that maybe they're not going to be approved for a loan and their credit score is too low, that would be a great opportunity to pull that credit report, which can be done free of charge, and take a really good look at it, preferably with a counselor. Go through line by line and see what can be fixed, what can be addressed, who can be contacted, what can be paid down. And as you go through that, and it can take months and it can take years if you're in some trouble, it can be fixed. You can get your credit score boosted back up, but it takes attention and it does take an effort.
And some people think that, especially if they're young, if they open a bunch of credit cards and do a bunch of stuff like that, then they'll show that they can use credit and they know what's going on. But that's probably, I saw all of your reaction to that. That's probably not the best thing to do, right?
No, I would say that you get credit because you need it, and if you don't need it, don't get it. Pretty much.
We're in some part of our lives we're going to need to take out a credit card for something, so let it just happen naturally, right?
If you're 21 years old today, by the time you're 60, you would have borrowed a little over $1.1 million.
Wow.
That's why the borrowing decision is so important, because you're going to be borrowing a lot of money, whether it's cars or credit cards or a house or a home equity line or a student, education or whatever. You can get to $1 million pretty quick when you think about that. So that's really, really critical.
Interesting. Okay, so I want to talk too about Thrive. We haven't talked specifically about that. Can you explain what the program is all about?
So Thrive is a financial success center. We have 4 locations with a number of partners in the region. And we have one at Thrive at HCC, Holyoke Community College, one Thrive at STIC, at Springfield Technical Community College. We have one in downtown Holyoke, and we just about 3.5 weeks ago opened one in Westfield, so Thrive at Westfield. And they all seem to bring on a little bit different type of client. We have different people walking in the door at each location, primarily students at the college centers. But they're 3-pronged. We help people with income supports. We help people with connecting them to workforce development resources, getting them into workshops, making sure they go through the orientations at the one-stop career centers, helping them find a second part-time job if they should need that. But our primary focus is financial stability. And the 2 ways we go about that are with money skills classes, which tend to be groups, and our main focus is on that one-to-one individual coaching. And it's long-term. It's meant to be a sequential process where we keep adding on more services, keep working with that person for long-term. And that seems to be a model that shows staying power. It offers people tools that they can use in the future, and after a while they don't need us anymore, and that's a great thing.
And this is free?
It is absolutely free. Our target audience is low to moderate income working individuals. If people are not working, we will still work with them. What we try to do is get some basic information, but one of our first questions is really, what are your short-term goals, what are your long-term goals? And then we start easing into working on a budget and maybe looking at a credit score, pulling a credit report, and that type of thing.
So how is the program funded?
We are so fortunate. We have some wonderful banks in the region who've been funding us, and some foundations as well. And they've been stalwart supporters since the inception of the program, and they were part of the design team from early on and helped us kind of figure out locations and target audience and services and partners. So we feel like we've got great momentum, and we do have to be out there pounding the pavement on a regular basis to get people to come in the door, but we've got a number of really wonderful success stories.
And you were saying a lot of people come through referring agencies, but
Yes.
people watching, could they just come in as well?
Absolutely. You can contact us at United Way. We'll put you in touch with the nearest Thrive Center.
Awesome. Hopefully people will take advantage of it. We could
I
all
hope
use a little
so.
help. Let's talk about what we kind of touched on earlier, the stock market. A lot of people find that really confusing. And if people are having some financial difficulties, they don't have that extra money to pay for a financial advisor unless, you know, of course they go through free programs and stuff. So is it worth it to play the stock market, and when should you start doing that?
I think introducing the young people to the idea of a stock market and investing is good to do. We have a program that we started, it'll be our 12th year this November, called the Stock Market Challenge. And we go from 8th grade through high school. Students go online, they have some activities that they do, there's online simulation, and then we bring them all together and they have an actual day of trading. They get I always have to tell them fake $1 million, because every time I say $1 million, they think I'm going to give it to them. So I say fake $1 million, and they get 60 days of trading, but every day is only a minute, so they feel like they're in Wall Street. But what they're really learning is the factors that can impact the things, whether it's a frost, you know, in Florida, and you own orange juice stock or a bottling company, or there's something in, you know, in insurance. So they look at industries. We tell them to read the newspaper, read online, and find out what's going on in the world, because that affects your money. And so I think that that's what we've been finding with the students is they like it. It introduces them to it, and then when they have the funding available, then they should be able to at least know what it is. Because a lot of them, when you go to work, they might say, "Oh, we do a 401k. Here, pick your stock." Like, what's a stock?
Right. Yeah. That's the confusing part.
We probably take the approach of financial advisors and financial planners, the professional people that do this. We really tell people that you ought to be thinking about that, and the reason why is if you think it's emotional dealing with your day-to-day budget, there's a lot of emotion when you're investing money that you possibly could lose. And when you have a financial planner or a financial advisor, they're not emotional about that at all. They're doing this every single day. They sit down and they have developed what your risk profile is, and they should be putting you into products that are appropriate for you so you can sleep at night. And you see this time and time again of people many times trying to do all this on their own, and the emotion just gets the best of them, and they just make terrible, terrible decisions, and there is no recouping of that necessarily. So we do a couple of basic investing courses that our financial planners at our credit union do to really just explain the goal setting that you talked about, which is critical here, concentrating a little bit on the retirement area. You know, if your business has a 401k, your employer, you know, take the match. It's the best way to double your money. You can't do it in any other place other than Las Vegas on black or red. And little things like that are critical. And also, we like to tell people that it's not the money you have, it's the amount of time you have to invest. A person who's 21 years old versus a person who's 61 years old, you know, if you're 21, you've got 40 years to invest in. If you're 61, you don't.
Right.
And so it's okay to start with $50 a month. if you start early, because you can always raise that amount as time goes on and you have money to be able to do that. So my advice would be to talk to an advisor, start early, and move it forward and try to increase it as your ability is. We always tell people, when you get a raise, can you give your 401k a raise? You know, can you take a little bit of that raise and increase that? And people don't even think to do that. And that's how you end up going from $50 a month to $500 a month.
Yeah, that's a smart thing to do. All right, we're going to take a break. We'll be right back talking more about financial literacy. You're watching 22 News in Focus. Watching 22 News in Focus. Today we've been talking about financial literacy throughout your life, from kindergarten through retirement, but we haven't really talked specifically about the big expense for a lot of people, which is paying for college. And a lot of times parents want to help their children pay for college, but it's a lot of money, hundreds of thousands of dollars for 4 years. So what are your recommendations for parents and students going into college in trying to make the most of their money?
Well, I think, you know, to begin with, trying to save for college is critical if you can do that as early on. Again, time is valuable to you. So, you know, when that child, and your example of putting money away when you were 16, I think that is exactly where you have to start with. The other thing I think is important is to be realistic with regard to going to college and where you're going to college. And you know, there's a lot of emotion and pressure on kids. And you know, we talk about, I had a guidance counselor say to me that you shouldn't borrow more than what your first year's salary will be when you're out of college. So if you're going to get a job that is $40,000 out of college, you probably shouldn't borrow more than $40,000 over that 4 years, because when you do the math, you can't afford the loan.
Right.
So it's a function of, you know, debt to income ratios, and so you have to be careful as to where you're going. Community college is a great place to start and then move forward if you want to save some money. But I really think it begins with understanding really what you're planning to do. You know, when I was growing up, you could go to college to find yourself, right? Well, you can't do that anymore.
No.
It's too expensive. You have to go in there and know exactly what you're going to be doing in 4 years and picking the right major so that when you get out, you can actually get the job to take care of those student loans. So I think it's that heart-to-heart conversation right up front, and trying to save for some of that.
Should parents be starting before their baby is born with saving for kids to go to college?
Absolutely.
Yeah.
Yes, if possible.
If possible.
Absolutely. We run into situations at the Thrive Centers where sometimes parent and child are both students at the community college, and that's always interesting. But one thing I would say for both of them, for anybody in the college, is to listen carefully to financial aid, to the people in that office, because they do explain everything in detail very carefully. And some things are grants, which don't have to be paid back, and some things are loans, and they do have to be paid back. And unfortunately, a lot of people don't hear loan, they hear grant. And so when they're moving on and getting out of school, they don't realize this is coming due. And again, they have to get some kind of a job that's going to afford them the ability to pay back those loans. And it isn't always clear to them. Or they may have come from another school and transferred, and they have this debt that they didn't think they had incurred, and it can become a bad student loan.
And keeping up with that, in other words, after each year of college, do you really know what you owe at that point? The time to know is not when you're graduating 4 years later. You need to understand that, you know, I've borrowed, you know, $10,000 my first year, so how much more can I borrow for the next couple of years, and staying on top of that. But that is, it's I think really understanding it and listening. And it's true, the last thing an incoming freshman wants to do is sit down and talk about finances with the bursar, you know. So that's really hard to keep them focused to do that. And that's where the parents come in. They have to understand that as well and make sure they know fully what's going on with regard to the going to be owed at the end of that 4-year period.
And I think the one way that a child can actually help is understanding that going to school before college, what they're doing in middle grades, what they're doing in high school, is their job. And you do it because you're investing in your education for the future, because that way you could apply for scholarships, you apply for grants if you show that you're well-rounded, you've had great attendance, you've done well in school, that's their job. And I think if they take it more seriously and understand that that's their work, that's their saving, and what they can do to help the family with the finances for school.
And it must help too, you were saying, especially Elms College students going back into high school with that knowledge now of them realizing they have real bills and loans they're going to have to pay when they graduate. That must help when they go back to high school and tell these students this is what you have to look forward to.
It does. The best one was the boy that told he wanted the sports car, and he said, I'm doing the sports car and I'm living at home, and this one college student goes, I did that. I said, what? He goes, I thought I needed the fancy car. I got a Caddy Escalade. I don't have a good driving record. My insurance is $6,000 a year. And the impact of somebody close to their age saying that was huge. And you know, those kids walked out of the class with a different perspective on, do I need this fancy car?
Wow.
You know, your point about, being in school and that's your job, one of the things that we tell our students is free money first. And you have no idea the millions of dollars that are left on the table for scholarships in this country every year. I mean, it is ridiculous. Hundreds of millions of dollars, so to speak, because nobody takes the time to go and Google online and look for scholarships. And we like to say, if you spend 10 hours online and you found one scholarship and you got it for $1,000, you just earned $100 an hour. And that's that senior's job. That's the high school senior. They ought to be looking for scholarships, and every year, and it's just amazing the weird little scholarships that are out there that you can get. So spend some time doing that, and there's a way to get some additional free money that you don't have to pay back. So that's critical, I think.
Wow. That is great advice. We've learned a lot this hour about financial literacy for all ages, really, and we have all of those resources for everyone. They'll be on our website for you to watch. We have the last word for you after the break. Stay with us. You're watching 22 News in Focus. News in Focus. Today we've learned about the importance of financial literacy, the programs and resources that can help you create and maintain financial stability, and best practices in managing your personal finances. So that's our program for today. We want to thank our guests for joining us, and thanks to you at home for watching. If you missed any of it, remember you can watch it at any time in full on our website at wwlp.com. And from all of us here at 22 News, we wish you a wonderful Sunday.